Another one of those stocks that haven't caught up to this rally yet is actually AMT, American Tower, is trading at 52-week lows. Most of you actually know the company is trading as low as what it was trading at in March 2020 and as low as where it was trading at in 2019. There's a lot of pessimism around this company, even though it's a high quality REIT. Most of you know it. They have a huge moat with these kind of, towers. So in this video, I'm going to try to analyze American Tower and try to determine if it's a good buying opportunity at such prices. Is it some kind of a value trap? Because as you could tell from this chart, there could be a massive opportunity for a comeback with American Tower, and it's actually offering a pretty good dividends that you could collect while you wait. So I'm going to discuss all of that in today's video. Now, American Tower owns those towers that if you're ever driving on the highway or on your street or something, you might have seen those kind of, tall looking towers. It's likely an American Tower. There's two of those companies. It's CCI, which is Crown Castle, and then there's American Tower, which is the bigger one. And American Tower owns those kind of, towers. They don't actually own the land. They lease the land, but they do build and they own the towers. And you have other providers like, T-Mobile, like AT&T, like Verizon, and all these kind of telecom companies. They lease the space on their towers of American Towers. So this is a beautiful business model. And the main reason why it's beautiful is because they only have to build one towers, but they can have multiple tenants on one tower. And the more tenants they have, they're not going to kind of experience any cost. So if they have, 5 tenants on one tower, they're just going to pay the expenses of one tower. So this is how the scalability of the business model comes in. And this is why American Tower has been an amazing compounder. You can actually see it here. This is an example. It cost them around $275,000 to build one tower for one tenant, but if they get 2 tenants or 3 tenants, it doesn't cost them any additional money. Now, if they do get 3 tenants, the revenue goes from 20 to around 80, which is pretty amazing. You could look at the return on investment. If they only have 1 tenant, the return on investment is only 3%. But if they get multiple tenants, like 3 tenants on one tower, for example, the return on investment goes to 24%, which is pretty amazing. They just have this one tower, and the more tenants they can get on this tower, the more return on investment they can actually achieve. And it's very sticky. It's hard to switch to a different tower, or you decide you don't want to have it on this tower, you go to another one. It's very hard to actually switch, which is a beautiful business model. A lot of super investors actually own it. Now, what sets American Tower apart from CCI and all these other companies is American Towers, the name is American Tower, but it's actually international. They own a lot of towers in Mexico, in South America, in Europe, in Africa, even in India, which is a rapidly growing market. I'm going to discuss India and in Australia, in New Zealand. They own them all around the world. And the best part about it is they have higher return on investments in these countries, like in South America, because it costs much less to actually build those towers. So they have a higher return on investments there, and they have much more diversification, and they have more growth than CCI, which is why American Tower is actually more expensive than CCI, because it has higher growth and also higher return on investment. CCI is only in the United States. Now, if you look at a lot of things that are actually going to drive the growth forward, and it's mainly in emerging market, and this is what the company said, that this is, example of kind of Samsung phones in Africa. It's 45% cheaper than the United States. In India, it's 12% cheaper for some kind of a phones they have. And these kind of countries like South Africa and India, where American Tower actually has a lot of exposure, a lot of the people, they don't even have access to internet yet. They don't even have access to Samsung phones and other kind of phones that they normally have. It's not a 95% penetration, maybe 50 to 60% penetration. So in some countries, it's even lower, which create massive rooms for growth for American Tower, because they can build more and more towers there, because those people, they want to get access to 3G, 4G, 5G, internet, wireless, whatever you want to call them. They need those towers, and American Tower has exposure to India and South Africa, which is really going to drive a lot of the growth forward. Now, the biggest problem with the company, and this is one of the reasons why the stock has been down so much, is the company has a lot of debt. And they made a mistake. They were trying to increase the dividend instead of focusing on either paying down the debt or focusing on actually maybe refinancing it whenever we had 0% interest rates. And if you look at the debt profile for American Tower, they've been working on it a little bit, but it's still around 80% of it, around 79% is something like fixed rate debt, which is fixed. It doesn't go up and down, but they have around 20% floating rate debt, which means that if the interest rate goes up, then their interest expense is going to go up, and it's really going to weigh on the EPS and on their free cash flow in general. You could see how the interest expense is going. It went from 870 million in 2021 to around 1.1 billion in 2022. In 2023, I believe it's 1.3 billion. It's even higher because the Fed has been hiking rates more, and the more the Fed hikes rates, the more the interest on a 20% portion of their floating rate debt is going to go up, and it's really messing up the balance sheet in general. This is the biggest problem with American Tower. Now, the good thing is that the weighted average, maturity is around 5.8 years, so it's nothing in the near term, although I would prefer 10 years plus, but 5.8 years is not bad for the short term. If you look at a lot of the maturities they have, and if you scroll down, most of it is actually paid for 2023. They have pretty much around $1 billion or $1.5 billion due every single year, which is not bad, and the company can actually manage it. I'm going to talk about their free cash flow profile very, very soon. But before I talk about the free cash flow profile and the interest coverage, I'm going to discuss the dividend, because most of you are going to buy American Tower for the dividend, and they have pretty close to a 3.5% dividend. It's one of the highest in the history of the company, which could give us some kind of indications that the company could potentially be undervalued because of how the dividend yield actually is as high as it's pretty much ever been. As the company does grow the dividends a lot, it's aggressive in growing them around 10 to 15% every single year. The dividend was $2.17 per share in 2016, and now it's $5.86 per share in 2022. So it's more than double, pretty much, almost triple, pretty close to that. So they do grow the dividends very, very aggressively, and this is why dividend investors really like the company. Now, if we look at if they can actually afford to pay the dividend, maybe, American Tower is going to cut the dividend, but I don't believe they will actually cut it. Now, they have been increasing it aggressively, and now they pay around $2.6 billion of dividends every single year. But if you look at the free cash flow of American Tower, it's around $3.4 billion. So it's around $3.4 to $3.6 billion of free cash flow, and they pay $2.6 billion in dividends, which would leave them $1 billion every single year for them to pay down the debt, to pay, everything else that they have to do. This is after CapEx. Free cash flow actually include CapEx. So after CapEx, after dividends, they're going to have $1 billion left to do their best and try to meet those debt obligations, which I believe they will be able to meet them in the short term because they have some cash. But over the long term, I am very worried about the dividend of American Tower. And the main reason I'm worried about it is if you look at the free cash flow kind of estimates, first of all, it went down a lot in 2022, but the main estimate is around 3.4 to 3.6 billion. Now, that doesn't leave a lot of margin for American Tower, because American Tower did say that they are targeting a 10% dividend per share growth every single year. Now, to me, this is very, very aggressive, and the kind of ratio between the dividends paid every single year and the free cash flow is going to narrow more and more, and they are neglecting paying down the debts. They're going to have to refinance them at much higher interest rates, and this is the biggest problem I have with American Tower, is they are focused too much on growing the dividends and not enough on actually getting the balance sheet to look a little bit better. Now, the company should operate with a lot of leverage because they have a resilient business model, which is the tower business. Such businesses, you can operate some leverage on them, but at least they should work on improving, the kind of interest rate profile and having more of a fixed rate interest rates and try to pay the debt off instead of just trying to grow the dividend every single year. So I believe the dividend is safe for now. I think the debt is manageable over the next 1 to 2 years because of the cash position and the free cash flow that's going to be left after paying the dividend. But over the long term, I would be very concerned about the dividend if American Tower continues on this path, unless they are able to massively grow the free cash flow, and they have been able to do that many times in the past. But I'm just a little bit concerned that if you just keep doing what they're doing, they're going to end up in a very bad place, over the long term. Now I'm going to discuss my valuation model to try to determine if American Tower is a good buy at such prices or not. And in this kind of graph, I did not use net income. I used free cash flow because I try to use either free cash flow or funds from operation within the REITs. But I put in 5% revenue growth from 2023 to 2027, which I believe is very, very fair on a historical basis. And this is also what the analysts are expecting. So I believe 5% is pretty fair to me for American Tower from 2023 to 2027. So the net income, which is the free cash flow margin, it's now at 32%, mainly because of a lot of the one-time expenses they had. They did some acquisitions. They also had other things going on with their debt. But I put in that it's going to go back to 35% in terms of a free cash flow margin 5 years out. And this has been their historical average. And I believe this is very, very fair. In terms of a PE ratio, I did not use that. I actually used a free cash flow multiple, price to free cash flow. Now it's sitting at 26 times earnings, as you could see on this chart, 26 times earnings. Now the mean average was around 28 times earnings over the past pretty much 11 years for American Tower. So in this kind of valuation model that I have, I'm not betting on American Tower going back to 45 times free cash flow. I think that would be very, very aggressive. But I'm only betting on it going back to the mean of 28 times free cash flow, which I believe is very, very fair. And I did include the 3.4% dividend. This would give me 64% on the upside, or 10.4% CAGR, which is actually not bad at all with a safe company like American Tower. Now, if I want to double my money buying American Tower, I would have to buy American Tower at a very low price, which is $160 per share, for me to get it double over the next pretty much 3 to 5 years. And $160 per share is very, very low. I mean, this is even lower what it was in COVID. So I'm not sure if American Tower is going there. To be honest, the company looks fine to me as a buying opportunity at such prices, because I believe there's a higher chance that if they do fix the debt situation, the price to FFO per share or price to free cash flow per share could actually end up being maybe in the high 30s, or maybe 36, 35, just like what it was trading at around COVID levels, or even 30 times free cash flow instead of 28 times. So it could end up being much higher than 10.4. And this also does not include the 10% growth of the dividend that they're going to grow every single year. So I believe personally that American Tower, it's not bad at such prices. It's not the best deal in the world, but I believe it's not bad at all if you have a long-term kind of investment horizon with something like this company, and you could buy it and dollar cost average down. But my valuation model is saying that it will most likely be a buy around $160 per share. I'm not sure if it's going there, but I personally believe American Tower is not really bad at such prices. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.